Gold isn't rising. The measurement is failing. Here's the paradox hiding in plain sight. Every chart tells you gold is soaring, smashing records, racing into new territory. But gold hasn't changed at all. Same weight, same form, same role. What's changing is the currency you're using to measure it. And that hits you directly because your income, savings, and future purchasing power are priced inside that system. Fact, between 1971 and 1980, gold moved from $35 an ounce to $800. The metal didn't evolve. The dollar lost roughly 94% of its purchasing power. Inference, what looked like a gold bull market was actually a currency breakdown. Now here's the part nobody says out loud. Today, the dollar still looks stable because it hasn't collapsed against other currencies. The euro-dollar rate barely moved for decades. But stability between two currencies doesn't mean value is intact. It can mean they're both sinking together. And if that's what's happening now, then the numbers people dismiss start to look less like fantasy and more like math catching up. The event everyone is reacting to looks simple on the surface. Gold keeps printing new highs. Commentators debate whether it's overbought, whether a pullback is coming, whether this is the top. But that framing misses what's actually happening. Fact, gold is rising while stocks are strong, bonds are still trading, and the dollar hasn't visibly collapsed. That combination shouldn't exist in a normal cycle. Gold is supposed to spike during panic, not during apparent stability, and yet here it is, climbing anyway. This isn't a single market move. It's a pattern forming across currencies, debt, and reserves at the same time. When assets that normally compete start moving together, it signals stress beneath the surface, not confidence. Something is being repriced quietly. Here's the question that reframes everything. What if gold isn't reacting to fear at all? What if it's responding to math? Because if the unit of account is degrading slowly, you wouldn't see chaos. You'd see normalization. You'd see markets adjust without headlines screaming crisis. And once that process starts, it doesn't announce itself loudly. It just keeps going until suddenly the old reference points stop working. Here's the claim that changes how this entire move should be read. This isn't speculative demand. It's structural demand. Fact, gold is rising without leverage-driven frenzy. No explosive futures positioning. No broad retail mania. No forced liquidation elsewhere to fund it. That matters because every major gold spike in recent history depended on panic behavior. This one doesn't. Now look at the concrete signal. Central banks have been buying gold at the fastest pace in decades. Not trading it, not hedging with it, accumulating it, physically removing it from circulation. That is not how short-term bets are placed. That's how systems reposition. Here's why that detail matters. Central banks don't chase returns. They manage survival. They care about what works when everything else fails. And right now, they're voting with balance sheets, not speeches. Notice what's missing from this move. There's no equivalent surge into other safe assets. Bonds aren't absorbing this demand. Currencies aren't. Even traditionally defensive assets aren't seeing the same pressure. That absence tells you something powerful. Gold isn't being chosen because it's attractive. It's being chosen because the alternatives are quietly losing credibility. And once the highest level of the system starts acting on that assumption, price becomes a consequence, not the objective. Now watch how fast this escalates. Once gold stops being treated as a trade and starts being treated as a reserve, the behavior around it changes completely. The market doesn't ask, is it cheap? It asks, do we have enough? That's a very different question. This has happened before, not in theory, in history. In the 1970s, gold didn't climb smoothly. It stalled. It broke out. It went quiet again. And each pause convinced people the move was over. But underneath, something was normalizing that shouldn't have been normal at all. Currencies losing value as a baseline condition. What's unsettling is how familiar the pattern looks now. Gold rising alongside stocks, rising alongside risk, rising without a visible crisis. That shouldn't feel normal, but markets are treating it as if it is. Here's where the story flips. When something abnormal persists long enough, it becomes accepted. And once it's accepted, positioning changes quietly, not dramatically. Institutions adjust exposure, reserves shift, allocations move without headlines. By the time it feels obvious to everyone, the repricing phase is already well underway. And that raises the next question. If this is normalization, not panic, what happens when pressure actually arrives? Here's the contradiction that permanently changes how this should be viewed. Publicly, the system still speaks the language of confidence, stability, control, soft landings. But the actions underneath tell a different story. Fact, sovereign reserves have been shifting away from paper claims and toward physical assets, not gradually, deliberately. Gold isn't being stored for yield. It's being stored because it can't be frozen, cancelled, or digitally impaired once it's held directly. That distinction matters more than price. Now notice the gap between words and behavior. If existing reserve assets were truly safe, this shift wouldn't be necessary. If trust in sovereign debt were intact, there would be no reason to accept an asset with no coupon and no issuer. And yet, that's exactly what's happening. Here's the line that reframes everything. Gold isn't rising because people expect profit. It's rising because large actors are planning for scenarios they don't want to talk about. Once reserves move this way, the process is hard to reverse. You don't trade back into vulnerability after you've escaped it. You don't replace neutral assets with political ones again. And when that mindset spreads from a few balance sheets to many, price discovery accelerates. Not because demand spikes emotionally, but because supply quietly disappears, which leads directly to the next pressure point. What happens when stress compounds instead of relieving? Now the pressure starts stacking. First, debt levels keep climbing, not stabilizing. Governments roll obligations forward instead of shrinking them. That means refinancing becomes permanent, not temporary. Second, interest rates can't rise freely without breaking something. Every increase tightens the system faster than policymakers admit. Third, confidence erodes quietly, not through crashes, but through hesitation, delays, smaller bids, shorter horizons. None of these look like a crisis on their own. Together, they remove control. Fact, when debt is too large to service honestly, it has to be diluted, either through inflation, financial repression, or policy intervention. There's no clean exit. That reality doesn't show up in speeches, but it does show up in reserve behavior. Here's the attention reset. This isn't about timing a collapse. It's about recognizing momentum. Once multiple pressures move in the same direction, the system stops responding predictably. Gold benefits not because it's perfect, but because it sits outside this chain reaction. No counterparty, no rollover risk, no policy lever attached. What happens if this continues? Not a crash, a slow narrowing of options. And when options disappear, reallocation turns urgent. Now bring it down to where you live. If the unit of account is weakening, it doesn't feel like a headline. It feels like your baseline's slipping. Your grocery run costs more, but the packaging looks smaller. Your rent adjusts to the market, even when your paycheck doesn't. A car payment becomes a longer commitment, a vacation becomes a calculation, and savings stop feeling like security. Fact, when currencies lose purchasing power, the damage shows up as friction. Everything takes a little more effort, a little more time, a little more sacrifice. You don't notice it in one day. You notice it when you look back and realize the same money buys less life. Here's why that detail changes everything. If gold is reflecting currency decay, then the conversation isn't how high can gold go. It's how low can purchasing power drift before people react. And notice what they didn't deny. No one promises your currency will be worth the same in 10 years. They promise stability in cross rates, stability in policy, stability in optics. But the lived experience is different. If this feels familiar, say so in the comments. Because once enough people recognize that this isn't a temporary spike, but a permanent recalibration, the next phase isn't about charts, it's about behavior. Step back from the emotion and look at the mechanism. This isn't chaos, it's incentives working exactly as designed. When debt grows faster than real productivity, the system rewards leverage and punishes holding still. When money can be created faster than value, anything fixed becomes more valuable by comparison, not because it's improving, but because everything else is stretching. Fact, financial systems prefer assets that can be expanded, regulated, or redirected. Gold doesn't cooperate with that. It can't be printed. It can't be modified by policy. It doesn't respond to guidance. That makes it inconvenient in good times and indispensable in uncertain ones. Here's the unsettling insight mainstream coverage avoids. Gold isn't winning against the system. It's revealing the system's limits. When institutions accumulate it quietly, they're not betting on disaster. they're acknowledging constraint. Notice how spectacle replaces resolution. Announcements substitute for fixes. Volatility becomes a tool, not a side effect. In that environment, long-term certainty becomes scarce, and anything that offers it attracts gravity. This note isn't about outrage, it's about architecture. Systems built on flexibility eventually collide with things that don't bend. And once that collision becomes visible, capital doesn't argue with it. It adjusts. Now look ahead, because this is where uncertainty takes shape. There are two paths forming, and neither announces itself loudly. On one path, policymakers manage to slow the erosion without reversing it. Growth stays uneven. Debt keeps rolling. Markets function, but confidence never fully resets. In that world, gold doesn't spike. It grinds higher, steadily, as allocations adjust year after year. On the other path, pressure accelerates, not from one shock, but from accumulation. A funding scare, a policy misstep, a geopolitical freeze, something small that exposes how little margin remains. That's when repricing stops being orderly. Fact, price discovery behaves differently once old reference points break. When numbers that once felt impossible become routine, momentum shifts from skepticism to urgency, not panic. Catch up. Here's the part that matters most. Both paths point in the same direction. The difference is speed, not destination. And markets care more about velocity than ideology. The next move doesn't need a headline. It just needs time. Because once positioning lags reality long enough, it corrects fast. And that sets up the final question. If this isn't a trade and it isn't a cycle, what is it preparing the system for? Here's the insight that ties all of this together. Gold isn't forecasting collapse, it's measuring drift. It's the one reference point that doesn't change while everything else slowly does. That's why its signal feels confusing. It's not loud, it's constant. Reframe the story this way. When gold rises, it's not telling you where the metal is going. It's telling you where the system has already been. It's a receipt, not a prediction. That's why this move doesn't end cleanly. There's no bell that rings when repricing is finished. It fades into the background, becomes the new normal, and only looks obvious in hindsight. If you're waiting for permission to take it seriously, you won't get it. Systems don't announce their limits. They reveal them slowly through math, incentives, and behavior. This isn't the end of the story. It's the first layer becoming visible, and the deeper question now forming is this. If gold is the constant, what else have we been measuring backwards? Follow for what comes next.